Inflation doesn't help because it's taking money from your pocketbook and not allowing you to allocate money into crypto because it's a retail-driven market. It also creates a lack of liquidity because the Federal Reserve, to stop the inflation, have been taking liquidity out of the system. So that means institutions and hedge funds have less liquidity to put into the system and therefore less flows into risk assets like crypto. Well, look, our vision and mission is to democratize the kind of very best financial knowledge. And it's not just about Real Vision members, it's about the broader world. We want to change people's lives at scale, give them the kind of information that the professionals in the financial markets get to level the playing field. And YouTube is something really important. We've got 650,000 YouTube subscribers. We want to get to 1 million because we want to build a bigger audience by adding as much value to YouTube as possible, because it's really important for us. We can't believe in our mission if at YouTube, which is our broadest audience, we don't deliver amazing products. So we've got incredible new series launching on YouTube. We've got a lot from behind the paywall that comes onto YouTube. Some of it's, it's delayed by a little bit so the members get it first. But we want to make sure that all of the YouTube fans get this incredible experience and they get to interact with us. So it's not like this stepchild that's kept on the side. It's like, we want you to be part of our core community. We really want to help. We really want to listen and want to help grow this YouTube channel into the channel that you all want it to be. So my big picture thesis is, from my forward-looking indicators, I do a lot of work for Global Macro Investor and also in Real Vision Pro Macro, two of my research services, on the global business cycle. And I particularly focus not on the data that's out today, where we are in GDP growth, but where we're going in inflation, where we're going in unemployment. My forward-looking indicators, which are like financial conditions that I've built based on the rate of change of the dollar, the rate of change of interest rates, the rate of change of commodity prices, from whether it's PPI, there's so many things, they are pointing to the fastest deceleration of data that I think I've ever seen in the shortest period of time. So what we're facing is a recession, which most people know, but I think the speed at which it happens is much faster than people expect. Now, There's this magic number, which is 47. 47 is the level at which it has a 100% chance of recession. Now, we're still in the 50s, low 50s, but all of the forward-looking stuff is going down to 47 for the shorter term stuff, i.e. the next couple of months, we should go 47 and maybe below, maybe 45. But the forward-looking stuff gets down as low as 35. So we're talking -2.5%, -3% GDP prints. And it should be bottoming by my work by about February, March next year. So the economy is about to go off a cliff. And I don't think the market is yet prepared for it. So I think we're going to start to see unemployment and inflation falling, the economy falling sharper than people expect. We're already seeing oil weak. We've seen all the commodities weak. Many of them are now negative year on year or close to it. So we've got this storm where bond yields are still high. They're actually, most assets year on year map the ISM really well. It's amazing. The business cycle is like this voodoo magic. And many people can see my threads on Twitter. I write about this a lot. I talk about it in Real Vision a lot. Is the year on year rate of change of the S&P, the NASDAQ, the bond yields, copper, oil, emerging markets, credit spreads, that all map the ISM. So most asset prices are pricing in a sharp recession. The bond market is not yet doing so. Now, why do I care about yields collapsing? Well, I've just told you that asset markets are actually pricing in a full recession. And I know there's a narrative out there that the markets need to price in a lower leg from earnings. But when I look at it in my terms using the business cycle, I think it's already priced lower earnings. So if bond yields start to fall, then financial conditions are easing. And the chances are the growthier end of the world, NASDAQ, crypto, growth technology plays will start outperforming. And we've seen many of those bottom a while ago when bond yields topped. So let's see what happens. But the next couple of months, I'm expecting it to be signaling a full recession. And we'll get to the tipping point where bond yields start to fall. It'll start affecting asset markets. So I'm not a believer we go to new lows. I've done surveys after survey and seen all the surveys on Twitter. 70% of all respondents in crypto and macro think equities go to new lows. Now, if that is the case, then most people are positioned for it. So therefore, the path of pain is the opposite. And I think the market's priced that in. So I think there's no certainties in this world. I can be wrong. But my view, the balance of probabilities are for me that the risk asset market, equities, crypto have bottomed. We are having a retest. And as the economic data shifts and bond yields come down, that'll drive that further, and it'll be a further hated rally because nobody will understand. We're going into recession. Why are equities going up? Well, because they already priced the recession. It's their job to be forward-looking indicators. Inflation doesn't help because it's taking money from your pocketbook and not allowing you to allocate money into crypto because it's a retail-driven market. It also creates a lack of liquidity because the Federal Reserve, to stop the inflation, have been taking liquidity out of the system. So that means institutions and hedge funds have less liquidity to put into the system and therefore less flows into risk assets like crypto. I think that monetary policy changes. It also lags ISM. It's kind of a weird thing. And it tells me that M2 bottoms right about now, which is what the crypto markets, I think, have been telling us. They're trying to find this bottoming process. And if I'm right, the economy slows down, liquidity is going to come up, and crypto is going to rally from here. Let's see. But again, I think crypto has put in a low. I think the ETH merge is a very big deal.
Yeah.
I think it's going to drive inflows. Yes, there'll be volatility. Yes, it won't be a straight line. But I think over time, it's going to put some security into the space because it's done and out of the way. Let's see. Let's hope there's no risk around this. It'll die some of the FUD narratives that are currently building as we move into this, which is only normal and people should question it. And then we'll see on the other side, when you've got this yielding asset that is a giant in the space, what that unlocks in terms of DeFi, the opportunities for institutions to invest, and other opportunities that come from a different asset. When the amount of money is growing, well, there's money everywhere. We can do stuff. Now, it means that it's easier to borrow money from your bank. It's easier to get a mortgage. It's easier to do all sorts of other things. But it also means that businesses have easier access to capital. Banks are not hoarding capital as much. So it means that money flows throughout the financial system. We're a system based on leverage and liquidity. So when money supply is shrinking around the world at the same time, it means that it's going to pull down all assets. And in fact, when we look at it, the bond market has lost $19 trillion in value globally. The equity market's lost $21 trillion in value. Let alone, real estate, crypto, all of these things. We've lost something like 40% of global GDP in this pullback. I mean, that's a lot of wealth that's been destroyed. Liquidity going up is good for assets. Liquidity going down is bad for assets. Liquidity negative, where it is now, has been particularly bad for assets, which is why we've had a bear market and we're pricing in a recession. The other big part of the equation is the dollar. The dollar is the key asset of all assets. It is 80% of all world's trade is priced in dollars. So if the dollar goes up or down, it matters. The dollar is driven by global liquidity as well. And there's massive dollar borrowings around the world. More people borrow in dollars than any other thing. So when liquidity is drawn away, people scramble to pay back their loans, and then countries go bust, like Sri Lanka did, and places like Colombia have been running into trouble. So the dollar has been on this screaming bull run It's now the second biggest bull run since 1996. I'm not sure it's yet peaked. It will do when monetary conditions back off significantly, but we're not there yet. Even if rates come down a bit, it's not clear the dollar will do it because Europe is a big drag, China's a big drag. There's some real issues out there in the global economy that means the dollar is still the kind of shiniest currency and the one that people want to own. So the dollar going up is bad for the rest of the world. So it's good for the US because you import more goods than you export, therefore the prices of goods goes down. For other countries, it's kind of inflationary, but what happens is they export stuff. So Asia is the big exporter. If their currency is weaker, it's also going to bring down the rate of inflation over time because they're selling goods. If the dollar goes up 20%, automatically their goods are 20% cheaper. So if you're importing them into the US, they become cheaper, importing into Europe or whichever countries. So it is good for lowering inflation. It's bad for asset prices. It's slightly complicated. And because of the amount of dollar debts, people need to be very careful of the dollar going too strong, too fast, because it blows shit up. Currency should not go parabolic, especially the largest currency in the world. It's a bad thing. And, I'm guessing that this is going to become a talking point for G7 nations, is like enough is enough. It's a big problem. Considering, for example, Europe imports oil. Japan imports oil. India imports oil. China imports oil. Oil is priced in dollars. And so they earn local currency and need to pay dollars. It's harder and harder to pay for. So it's bad.